Well, good evening, everybody. For those that are new, welcome, welcome. For those that are repeating, been with me with future or past webinars, I should say, welcome back. So today we're going to discuss how to build a trading strategy. So before we get into that, as usual, the risk disclaimer, and just give everybody a minute to read that. Yeah, that should be long enough. Right, moving on. So what are we going to do? As usual, we'll have a quick introduction. I'll just explain a little bit who I am, what I do, nothing too fancy. Then I'm going to touch on trading strategy versus trading technique, because there's a lot of confusion on that, generally because techniques are called strategies. Then we're going to discuss the concept of your trading strategy, and we're going to go into looking at how do you formulate a foundation, so how you start making one. And then we're going to actually basically run through how I would build a strategy, right? How do you set it up? What do you think about? And then set it up. And at the end, as usual, we'll have an open floor Q&A, and you guys can just fire away there, obviously related to the topic. Moving on. So first of all, who am I? Well, like I said, my name is Mike Rotink. I am 35 years of age. I studied international business studies in the Netherlands. During this period, I was working with a lot of, basically finance for myself, just for fun, part-time jobs, doing calls in the finance industry. And then I started having fun with my own trading account when I was young. And as most of you, screwed up the first few. But eventually, I started getting a hang of it, started getting good at it. Basically just turned the hobby into a little bit more of a serious venture, which brings me to what do I do? So in the past, what I used to do is basically work with brokers and analyst desks to provide the signals for them, like the Telegram ones, look at different options, and just do general account management at retail brokers, like most of you are probably used to. From that, I had quite a bit of success with my clients, much to the brokers hate. Yeah, but I started basically doing it on my own. Started doing mentorship. Wait, is anybody having issues with voice? The chat is open. Just somebody, if you can hear me, okay, please say so. Just checking because I'm getting a message here. Everybody can hear me, okay? Everybody can hear me, okay? All right, so I can't fix it if it's on their end. Perfect, thank you. All right, so where was I? Right, yeah, so I started doing the trading. I got very good at, got successful at it. Obviously, I wouldn't be here. And recently, I transitioned into putting all the accumulated amount that I have towards the goal, which is what we're going to discuss about. And I'm now, basically advancing myself in the next step, which is looking at becoming a financial advisor, and obviously a little bit with a niche towards investment advice and things like that. So yeah, that's where I am right now. Very riveting, all of that, but let's get on to what we actually came here for. So trading strategy versus technique. The reason I put that in here really to touch base on is because a lot of people confuse what the technique is versus what strategy is. A strategy, your trading strategy, should be an all-encompassing terminology for how you approach trades and how you trade within it and how you manage your portfolio. That should be your trading strategy. Now, when a technique is involved, often you get the word strategy, but it's actually a technique. I'll give an example. My strategy is scalping. That is not a strategy. That is a technique. It is a way of trading, right? So naked chart, swing trading, scalping, day trading, zigzag fishnet, like all these things, they often have the word strategy at the end. They're not actually a trading strategy. They're a technique. It's a way of trading certain things, but it's like it touches on the base of what a strategy is, but it's not fully fledged. And I wanted to make sure that that's understood. We're not going to discuss how a zigzag works or how a fishnet works or how naked trading works. We're going to look at how do I build a strategy with only one thing in mind, becoming consistently good and profitable, hopefully. So what is the concept of a trading strategy? Well, first of all, what is the goal of a strategy? There's a few points to what the goal is, but the first and foremost one is to remove your random approach to trades and have a consistently repetitive system with which you approach your trades, creating, if done correctly, a consistent result, regardless of market situation, when put into place properly. So this is basically, if you want to make it simple, if you have a good strategy, you should have a consistent result, and thus you try to get a consistent result, profitable. Why is because there's a lot of cowboy kind of techniques out there and strategies where it's more of a gambling thing than anything else. Everybody knows the voice of slow and steady wins the race. And with trading, that's no different. And your trading strategy should be aimed towards that content, because there's two ways you're trading. You're one of two people. Either A, you want to trade and make money fast, or B, you're an investor that's doing self-trading and you're trying to make your money grow. If you are the first, you don't need a strategy because you're just playing gambling. Do whatever you want. It doesn't matter. You're not going to be successful. Sorry to say it. That's going to be the rule for 99% of cases if that is your concept. The 1% is that success story. Hey, I put 5,000 in and I walked away with 50. Okay, great. Do that 3 more times and see how it goes. I will guarantee you're going to lose more than you win. This is where 80% of retail traders are based. They have the intent of being part of the 20, but they're trading like the 80. 80% of retail traders just don't make it. It used to be 90%, but people got a little bit smarter, information got more readily available. So, there's a little bit of a curve there. But, to be in the top 10%, let's say, forget about the top 5%, let's say the top 15%, it's just a matter of developing a good strategy, getting consistent, and just trading for a goal, trading towards something, right? So the goal of the strategy is to get consistent, to get your repetitive results depending on different market situations. And yourself, if you've met me in different webinars, you should always have a goal. What are you trading for? Right? This is important to have in mind. Now, the other thing is to understand, how do I build my core structure? How do I build my foundation? And we're going to go circle back on that on the next one. We're going to look at, breakout foundation a little bit more. But your core structure is consistent of several aspects, not one. Right? You're going to have risk management in there. You're going to have your trading technique or techniques in there. Right? And risk management we can break up further. Right? Risk management can be break up between your risk level, right? So how much percent of capital are you using per trade? How are you exposing your trades? What is your portfolio spread? So how much is in FX? How much is in CFDs? How much is in commodities? How do we balance that out, right? So this also depends on what is your capital like. If you have $1,000 account, great, but you can't do a very elaborate strategy. The reason for that is because you just don't have the ability to do multi-level risk management. You're going to have to simplify it. Capital determines what you can do. And unfortunately, this is truly the world where the more you have, the less chance it is to fail, because you can spread better. Less is more. Right, so your foundation is also a set of rules. And we're going to get back to that. I'm going to build those rules with you. I'm going to give you an example. And obviously part of your strategy is, okay, how do you balance technicals and how do you balance fundamentals? So not only understanding fundamental drivers of a pair or of the market or of anything, it's also understanding the economic calendar, which is those bursts of news announcements, because you're going to find out what kind of trading you're going to do. And all of this is I'm going to elaborate on everything of this down the line. Your technicals, well, you have to decide how much of it do you want to be technical and how much do you want it to focus on fundamental, right? You want to do a 50-50 split? Fine. You want to do a 40-60? Fine. To be honest, most cases, the markets move based on fundamentals and then move with the market makers because they're the ones making the market move, not you. If your mindset is, I can beat the market, you've lost. You can't beat the market. You're too small. Just accept that. You cannot make the market move. You don't mean anything. You're a drop of water in an ocean. I don't care how big you think your account is. Right? You can be a $500,000 account, which is huge for a retail trade account. Maybe $1 million. I've had 1 or 2 clients with that. They thought they had the biggest accounts in the world. They don't. You're a drop of water still. You are absolutely nothing. Right? The money that goes on in this market is insane. So stop trying to beat the market. We're along for the ride. The 20% that I mentioned all understand this concept. You are part of the ride. That's it. You're not trying to beat it. You can't beat the system. You're not smarter than everybody else before you. Just learn to go with the flow. Your goal is, hey, look, my technicals say A, the fundamental drivers say B, and my fundamental, I might have a few things. Yeah, Francisco, 90-99 rule, right? I'll elaborate on that later, by the way, people. So this is, these are the things, right? You need to understand that you are not going to make a difference except for yourself. Make a difference for yourself because the world doesn't care if you get more or less money. Sorry to break it to you. Nobody cares. You care. Your bank account cares. Your family cares. The rest of the world doesn't. Right. So, and this is a fundamental flaw I find with people that when I do coaching is the mindset is completely wrong. They try to beat the market or to try to be smart or, hey, I read this about some kind of hidden technique about price action and I'm going to do a breakout technique. All right, great. What are you trying to do? You're trying to predict market movers do? Good luck with that. You're a one-man band. You can't beat an army of a few thousand. Stop trying to. Right, so here you have your concept, right? So this is part of it. Now, understand me correctly. There is a lot more to this than what we are discussing now. A hell of a lot more. It gets as complicated as you want. But the core construct of the concept of it is it's a fundamental compilation of different aspects that formulate your strategy of how you are going to approach every single trade, regardless of what it is, and you are going to, with that, get a consistent return. There's a way you go about that. So let's formulate a foundation. That's where we start, right? So first of all, what times are we trading? Right? Are you going to be doing short-term time frames or short-term times? Right? Are you going to trade in the morning, in the midday, in the evening? At the opening, at the close, during the peak times, in between? What are you going to do? What is your plan? Do you want to do small bursts? Or do you want to do the entire day? A lot of retail traders think that you don't have to plan these things. You do. You can't just randomly jump in every time because every market moves in a certain way at certain points of the day. So you need to learn all of them if you want to do an entire day. With time, you will get the experience. You will do this automatically. You will know exactly, oh, hey, in the morning I need to watch this, in the evening I need to watch that, and everything in between I need to watch this, depending on where you live, because it doesn't matter where you are. You know roughly the time of the market. I'm talking about the markets morning, midday, and evening. I don't care where in the world you are. Well, it could be 3 a.m. in the morning, but it's morning somewhere. So that's your concept of trading time. But also, do I trade a day? Do I trade 48 hours? Do I trade 10 minutes? Do I trade an hour? Right. Personally, I hate short-term time frame trading anything under an hour, mainly because it just feels too gambly. But that's me. I mean, I know it can work for people, but in generally speaking, just the gains are too small. I don't really care about any of that. So what is important to look is your trading time. What are you looking for? Right? Day, intraday, weekly, monthly, anything in between. Combination of the two, like start everything off as a short-term time frame, but build on your winners is something that we discussed in a previous webinar, how to build on your winners, right? How do you expand on your existing trades and let your winning trades be the blanket for losing trades and then continue on that? Right? These are all parts of your strategy. These are all little bits and bobs that you put in and that you make specific rules for. And this is a very big point that I filtered out later. We're going to actually make that together. And then obviously is the trading time frame, right? Like I said, are you going to be trading on a 15-minute window? Are you going to be trading on a 1-hour chart? Are you going to be trading on 4 hours? Day? Combination of all of them? Remember, for the ones that did technical analysis, we always do top-down analysis, right? So you basically utilize them all. But which one is going to be the main one for you to initiate and exit trades? Right? Entry and exit strategies. That's part of your strategy, right? It's a dot on the wall for your strategy. It's a concept. It's a part of it. You can't just randomly decide. You have to stick to something, because think about it logically. If you do random acts all the time, how can you possibly expect consistent results? Somebody surprise me and tell me I'm wrong. You do only sporadic things and you expect a consistent result. You'd be the first person on the planet I would love to sit down with you and tell you and pick your brain how you did that. I can guarantee you none of you did. I will put my hand in the fire for that one. And then we get to, what am I trading? So this comes back to the thing I mentioned earlier. You can't just randomly trade everything. Your capital is the detrimental indicator of what you can and cannot trade. Yes, I know you can put stop loss and you can hit small lot sizes. Look, when you do stop losses and things like that, those that did entry point and exit points and the fundamentals with me and the technical analysis, you combine all these past webinars with me, you will understand exactly why I say that's not how that works. Right? Putting a stop loss on a fixed amount of pips makes no sense, because generally speaking, it's very inconsistent when you come to risk reward ratio. But secondly, what's very important is that the stop loss should always be in a place, let's say, where the market should only go if the market changes in a fundamental aspect from what it should be doing as what it's been doing. Because remember, we're trading, we're riding the waves. We're not trying to beat the market. You can't, you never will. Yeah, you might get lucky, but that's not consistency. All we ever do, the only thing I ever care about is one single thing. Get consistent. That is the only thing that matters. So what am I trading is a very big part of that. Consistently trading the same things, getting a feel for them, how they move, when they move, what they move like. This is learning. This is part of your strategy. And it also means part of your risk management, your exposure. What is my balance? How much of FX am I going to put in there? How much of CFDs? How much stock? How much cash? How much foreign investment? This is if you're doing whole asset. Most of you won't, but let's say the retail trade. How much of it's going to be FX? How much is going to be CFD? And how much is going to be commodities? Right? How I balance that out? What's my risk level on each and every one of them? How do I fully utilize my capital and trade with that? Right? Again, something we discussed. If you are trading with, let's say, $1,000 or $2,000 account, but you're like, yeah, I only risk $200 from my account, then why did you make a $2,000 account? Make a $200 account and go to the bar with the other 1,800. What's the bloody point? You trade with the capital you have. You never put all your eggs in one basket. You have a limit on percentage of capital that you use, right? Risk and reward. But it also determines what you can trade. If 5% of your capital is 40 bucks, you cannot trade oil, period. Stop trying to. Right? Because your stop loss wouldn't make any sense if you look at the average daily movement. Then we get indicators. I always get this question. What about indicators? Yes, they're part of your strategy down the line. Right? Moving averages, stochastic, RSIs, Bollinger Bands, Fibonacci, whatever you want to use, I don't care. Right? You need to decide for yourself, what am I going to use consistently and how should they be set up? For instance, with moving averages, people always ask me like, well, what setting should I use? Well, it depends. What are you trading? Depends. What kind of time frame are you looking at? Because each time frame has a different setting. Right? The market in a minute moves extremely fast and is very volatile. And I say that with brackets here because there's no such thing as volatility nowadays, or not real volatility. What I mean is that it's very inconsistent, right? It's a buy 1 minute and it could be a sell the second minute and then 3 minutes up and then 2 minutes down. So your moving average should be reflecting that, right? Or if you, let's say, use a triple moving average, they should be reflecting that and moving that way. If you then switch to let's not go too big, a day chart, you cannot use the same settings on a day chart because that would make absolutely no sense, right? The market moves way less sporadic. It's way more predictable. It's much slower going. It's also bigger gains. We also need better capital in order to set those up properly because you need to go big, right? So that's indicators, right? So they're part of your strategy. What indicators am I going to use? How am I going to set them up? And then the last one is very important. In what market situations do I want to trade? And which ones can I not trade in with this strategy? There's no strategy on the planet that applies to every single market condition. Your approach to trades, yes. Certain techniques don't work in certain market conditions. So if your strategy consists of using one singular technique, AE, either scalping, I do either scalping, I do swing trading, I do forget about day trading. I do zigzag, I do fishnet. If in certain market situations, those techniques do not work, or in certain, what do you call them? Certain currencies or certain instruments, that's the word I was looking for, certain instruments, and they just don't work, right? Because the way they move is different, the reasons what they move is different, etc., etc. Right, so far that makes sense, I hope. So let's get a little bit more into the fun stuff. Now we're going to be building a strategy. I'm going to help you guys build a strategy, at least show you how you basically go about it, right? So first of all, when you build a strategy, what's a big part of it is the bloody rules. When we think about a strategy, if you really tone it down and just would have to describe a strategy in one sentence, it is a set of accumulative rules to create a consistent approach to trading. One sentence. That's it. And that's why in the next slide, we're going to build out the rules. I'm going to show you an example of, let's say, 4 rules, how you would be looking at that, right? So that's the first thing you have to do. You have to build your strategy using the rules. So let's go do that. So here's an example that I just slapped together real fast. But let's start with rule number 1. First of all, think about this way, right? I wake up in the morning and this is what I follow for every single thing, regardless of where the hell I'm trading or what I'm doing. I wake up in the morning, I turn on my desktop. Please don't tell me you're trading on a phone because I will slap you. But so you sit in front of your chart and you go like, okay, first of all, is it a bullish market or a bearish market? And for the love of God, don't be one of those people that goes like, well, the stock markets are up, so it's a bullish market. That's not how that works. Learn the difference between a bullish and a bearish market. This is trading sentiment. It has nothing to do with what direction the market is going. Well, it does, but not, you get the point, right? There's a certain characteristic to both types of markets. right? Positive, negative, long lasting, shorter lasting, more volatile, more opportunity versus very slow, steady, not much to do, right? Bull bear, right? I'm pretty sure most of you know that. So that's my first rule, right? And you only do that once because that's not going to change that often. So, is the bullish or bearish market? Okay, so let's say it's a bullish market. Okay, sentiment is generally positive, which means trends will generally last longer. There's can be a little bit more of pullbacks, but they generally recover really fast. Okay, good. So I know that. So now, do I go long or do I go short? Without doing any technicals, without doing anything, without even looking at the chart, you could flip a coin. All right, so today I'm going to go flip coin long. All right, we're going to go long. All right, let's say we go long. And my target is 25%, 25, 0.25, no, 25% of the average daily movement range. Sorry, it shouldn't be 0.25, it should be 25. Forget about that. So 25% is my target in my strategy now, the average daily ratio of whatever I'm trading. My risk is also a maximum of that. I know that's not a risk, that's one-on-one. I know. Forget about that. We're simplifying the example here, right? Because risk management is further down the line with your rules and your regulations where you put yourself a 1-to-3 rule, a maximum of 5% capital. I know. Also, forget about commissions and spreads and all this kind of stuff. We're factoring that out. I just want to keep it simple right now. So let's say rule number 1 is these criteria. Good, right? So I have, let's say euro US dollar. I coined a flip. Flip the coin, Jesus. Flip the coin. I am going long. My target is 25% of the average daily range. And my stop loss is also about 25% of the average daily range. Right, fine. Forget about technicals and analysis and don't think that this is a fixed stop loss thing. Right, this would be a way more elaborate if I would actually write down rule 1. Now, rule 2. Let's say you have an indicator. Let's say you have a triple moving average. And you decided, this is rule number 2. I will continue with my long if my moving averages have a 250, 150, and 50. Forget about the numbers, it's just an example. Right? So that is the rule. If so, then yes, I'm still go with my long. However, if not, my long just turned into a short. Good. Everybody with me? Perfect. Now I check rule number 3. Okay, so I in the previous example, we decided, it was a short, but let's say we keep with a long from rule number 2. So now rule number 3, double check, third checkpoint. Okay, is the market overbought? Whether you're stochastic or RSI, whatever combination of the two, whatever. It's overbought. Volume-wise, I don't care what you use, you have to decide that for yourself. But you see that the market is not overbought. You still continue with your long position. However, if in the previous rule it turned into a short, now we look at the short, is it not oversold? Because then it doesn't make much sense. And then we're going to have the next fun part, right? So that's long over short. And people go like, well, this is very simple. Yeah, but you can make it your own, right? So each rule you can set up yourself. I'm just giving you an example. It's basically the idea of how you buffer different criteria. Think about it as an organogram, right? Let's say you write down your company or the company you work at or whatever, and you write down CEO and then the PA and then the board of directors and you name it. Like you write that whole thing out. Well, this is basically your flow chart. So before you are allowed to press the button trade, you have to go from the top all the way through that flow chart. Flowchart, that's the damn name. You go through the flowchart with yes, no's until you get to the bottom where it's a yes, and then you open the trade. And this is after obviously you identify the trade. But so rule number 4, let's say. Now I had long, long, long. Good. Now I'll get to rule number 4. If the trend is up, and currently the market is at the bottom of the channel, my God, what an entry point. We're going long, boys. Right here, right now. Oh, wait, it's actually at the top of the channel. So yeah, it's not overbought. Yes, it will still be a buy, but it's in the top of the channel. I better take a short now because it's more likely, right, to turn, pull back a little bit, and then you can do two things. You wait for price action in the top. So rule number 5 could be confirm price action. Or rule 5 could be if rule 4 turned long into short, right? Decide, don't trade against a trend. Okay, fine. You have a small account, so you can't really take both sides of the trend. You have to you have to go with the most stable option, which is with the trend, right? Not the trend is your friend thing. It is kind of, because especially in a bullish market, but like in general speaking, what you want to do is buy the dip. Right, so let it pull back and then buy. The market's not going anywhere. You can wait for a few hours or let it be a day. Right, you're not trying to get rich between now and in the next 10 minutes. You can wait. Market's not going anywhere. It'll move the way it moves whenever it wants to. Right, so that could be rule 5, or rule 5 could be, if the sky is blue outside, I'll take it. Like, make it whatever it is that you want, but make sure that you consistently follow your bloody rules, because otherwise it's pointless, right? The whole idea, again, and I keep hammering that, is to create consistent results. Now, how many rules should you have? Because I know that question is going to come eventually. That is up to you. I had 8. Fairly elaborate, and then there was my risk management was a separate beast. But I had a rule for initiating the trade. I had a set of rules for initiating the trade, a set of rules for maintaining the trade, and a set of rules for deciding whether to exit or not the trade. So I had 3 sets of rules for the 3 stages of your trade: entry, during, or before, during, after, or end, right? So start, middle, end. Say it that way. I think it makes more sense. Right, and each of them had a different risk management idea. Obviously, when the trade is moving, you have a different micromanagement of your trade than when the trade is at the end or at the start. There's also different factors that you factor in between, right? And most of them had to do with criteria on to continue, to build on my winners, to set up trailing stops, to not set up trailing stops, to look at what kind of angles do I want to look at. And this just creates that consistency. So what is important is that you set up rules for yourself, and do like me. If you're the stubborn goat that think he's smarter than everything, stop it. Make a sticky note and just stick it on the damn wall next to you. I'm not joking. That's actually what I did. I had a sticky note, actually on the side of my computer, was next to my monitors, that every time I would read them, like, did I go through that bloody checklist? Because 9 out of 10 times the trades that I did lose, I didn't follow one of the rules or I overlooked something. Doesn't mean you're going to have a 100% win rate. Win rate is irrelevant. All right, for those that were with me at risk management and the basic trading, you will know that 40% win rate is all you need to be profitable consistently. You do not need those retarded 90% win rate things. It's complete BS. You don't need that. 40%, the more you do, if you can do profitable with 40%, well, yeah, obviously, if you do 60%, you're even more profitable, duh. But your first target should be consistently break even or slight profit. And then as you get comfortable with that, you get expand, you get a little bit more knowledgeable, you get more feeling for the trade, you start expanding it, you start expanding it, you start expanding it. And this is how it will organically grow. If I would write you out the 3 sets of rules, the full trading strategy, and just go here, here's Mike's strategy, and just dump it on your lap, what's going to happen? Who is willing to just give me a quick say like, okay, what's going to happen with that? Just feel free. Nobody's willing to give that a shot? So what is going to happen if I would give you my full set of strategies, the way I used to trade, and just dump it on your lap and go like, there you go. What's going to be the result of you doing that? Me giving that to you. What's going to happen? I love you guys. Yeah, everybody's like, yeah, that's not going to work. No, of course it's not, because I built it for me. I know all the little itty bitty things. Yeah, but even if you would understand the strategy, you won't get it to work because it's not your strategy. You don't even know what the thought process behind it was when I built it. Even if I would explain it to you, you'd still be like, uh-huh. But what happens when the variables within that strategy change? Because if you think about it, when you've built up your strategy based on rules and what ifs, what are you really doing? You're technically building an algorithm. There is variables within an algorithm that change, and I know when they change, but you don't, because you don't know which ones are variable in my head. So you have to build it yourself. This is one of the big things that I have with those social trading platforms. Great, but if they were so good, then why does nobody make money on these things? Barely anybody. Like, shadowing somebody is not a strategy. That's fingers crossed and hoping he doesn't screw up halfway through. Think about it. How many of these social trading platforms, and I know every single one of you have looked at it, and some of you had accounts with it, either the one with the green horns or the other orangey one. You had an account, you followed somebody, he was doing great, and all of a sudden, he blew up the account, or he disappeared, or he stopped trading, or whatever. Sound familiar? Anybody? Ring a bell? Exactly, right? Everybody, yeah. You know why? Because it doesn't work. And the way that these, I would be horrible as a signal provider. You know why? I don't trade often enough, and I don't trade according to what people want. See, we're all greedy little bastards, every single one of us, and we all want to be rich tomorrow. So what do we like to see is traders that are consistently profitable with high amounts in a high % win rate. Lest we forget that the one time they do lose, they lose the entire flipping account, but you don't see that because it hasn't happened yet. So everybody clicks on follow, and then it goes well for 2-3 months. It goes well for a year. And the people that quit at that, basically what you did is beat the house, right? Because basically you're just gambling, and what you happened is you just simply beat the house. And we all know that does happen, but not often, because most people are going to say, you know what? This is going to work. I am going to make a shit ton of money off of this. And all of a sudden, boom, shit, where did my account go? Oh, wait, the trader went bankrupt. Bugger. See, the way these algorithms works on the social trading is trade as much as you can, as often as you can, right? So that's not trading, right? So scalpers, yeah, they get really high in the ranking because they do really high volume, and they have to have a really high win rate. Doesn't mean it's good. Right, so we made a bunch of rules for ourselves. We have a core foundation of rules, and we have 3 sets. We have one for the start, we have one for the middle, and we have one for the end. Or you can make at the start, especially when you're beginning, you just need one set of rules. It doesn't have to be many of them. Just make 5 or 6 rules. And just every trade, after you've done your analysis and you make sure there's no economic calendar announcement or anything like that, you decide to open your trade and you go through your rules. And if then you have a positive outcome at the bottom, you click on the button and you open the trade. And then you do the following. I'm going to tell what everybody should do. You close your trading thing and come back in a few days. because you've either won or you lost. What happens is people monitor it and start screwing around with their trades. Like, yeah, I trade with 1-to-2 or 1-to-3 risk ratio, but I always lose more than I win. Yeah, because you're not trading 1-to-3, you're trading 1-to-1.5 or minus 1.5 because you keep manually trading the click because you start having second thoughts. You have to commit to the trade. And what I do when I mentor people is I force them to keep the trades open for the very simple reason, if when you screw up, you should feel it, because nothing is a better teacher than just a slap in the face and you lose some money. It's the only way you're going to start to focus and start learning from your mistakes. It's that simple. So next part is setting up your chart. So this one is pretty straightforward. Setting up your charts is very simple, right? Use your MT5 or your web-based one, whatever it is. I would recommend downloading an MT5 with any broker that you have, one that saves your settings so that you consistently look at charts the same way. Again, consistency is the key. You have no idea how many people I find, they trade with laptops, they trade on websites that don't save settings, they trade on, I don't even want to say it, phone. Like, please don't. Come on. Be honest to yourself. Can you really do proper trading on a phone when you're like looking at that 7-inch screen and your thumb is bigger than half the screen if you're me? Come on, guys. And girls. And anything in between. Right? It doesn't work, right? Get yourself a desktop or at least a laptop with a big screen. And when you decide to start trading, sit your ass down and do the trading, not YouTube and watch Netflix and everything else at the same time. Focus on what you're doing. Right? It's basically a job. If it was so damn simple to just make some money on the side, trust me, everybody would be doing it and would be a lot more of people like me. But there's not. Right? Because nobody wants to put in the effort. Everybody thinks, yeah, we'll do it on the side a little bit for fun. Fine. If you do it for fun, then that should be your expectation, to lose the money, like the casino, where you go for fun. You might win, probably not, though. Right? So your chart setup is very simple. Just make sure you have the same view and the same settings, whether it be pink on purple on whatever is your fancy, but have the same view. So you always look at charts the same way, so you have the consistent way of applying your rules, a consistent way of viewing the market. So yeah, that's very, very important, because there is a difference. Like if you look at one chart in one view and one chart in another view, like it does affect you, right? Because we do tend to still eyeball things. You will always do that, right? Indicators are flawed by default. Right, I'll get back to that later. So now risk management. So risk management itself is part of your strategy, especially here. What is going to be what is going to be your risk profile? Are you going to be using 2% of capital per trade, 5% of capital per trade, 10% of capital per trade? Should not really be more than that. Most of you should be doing between 2 and 5. Because think about it, if you do it 5% per capital, that's 20 consecutive trades at the same time. Not, I have a trade open on euro US dollar. Okay, this goes back to why do you have a $2,000 account if you're trading with 5% of it? What's the bloody point? Then you don't need a stop loss because you have $2,000 just to move around with. Right? Obviously, always trade with a stop loss. But like, this is one of those things, right? What is my exposure like, right? Do I want to be exposed more to Europe, more to the US, more to Asia, more like, where do I have a better understanding of fundamentals, of fundamental drivers, what makes those markets move? And this takes time. At the start, you will know nothing about anything. And for those, I usually advise, start with 1 or 2 pairs, learn them inside and out. If you do that in 6 months, good on you. You do it in a year, it'll take a year. The end result of everything that I'm saying is that you will start getting consistent, meaning that eventually you will start doing consistent profit. And guess what, people? When you work with percentages and you do a percentage thing, it's called compounding. So this will accelerate like crazy. You don't need to be good right off the bat. It just needs to come over time where you're consistent, and it will start launching itself. Right? This is like the example I give people. I can give you a penny or a cent that doubles itself every day for 30 days, or I can give you 2 million in cash right now. Which one do you want? 90% of people say, give me the 2 million. And there's 10% of you smartasses that actually do the math and go like, wait, hold on. The cent turns into like 5.5. Because it doubles in the last day. And in the last 3 days, you make more doublings than anything else combined. That's what people don't understand. Right? So compound is what you want to aim for. You want to build a strategy that has a compound interest kind of growth. This is if your strategy's goal is to grow your money. If your strategy goal is to get a fixed percentage of return on your money every year, as if you were in the bank, first of all, this is a risky way of doing it, but it can be done, right? And you will consistently take out whatever excess of the starting capital you have, then your capital will never actually grow. You will just, give yourself a bonus at the end of the year, or not, if you didn't do it right. Right? But if you aim for something low, like let's say 5%, keep in mind, if inflation is 2.8, you didn't do 5%. Right? Because, it went 2.2. Because you have to take inflation off of your value. Right? So risk management comes all about how many trades consistently open, how many exposure, et cetera, et cetera, et cetera. All these factors you put together into a strategy. And risk management is a huge part, because that determines how you're going to grow your account. And this one is also one of the variables, because remember, your capital determines what you can trade. So little aspects of your risk management change as you grow, or hopefully you're growing. And here's the last one. Back testing. If you have a strategy, bloody back test it. There is a history in your chart. Use it. And you do it incrementally as you set up rules. First, you have a technique. Let's say you do zigzag. You go into the history and you test it. Does it repetitively give me the same type of results? If the answer to that is yes, good. You have a technique that works in market situations that fluctuate. Not completely change, fluctuate. Now, moving forward, we add rule number 1. Now I'm going to apply rule number every single one that I just said I would go in and apply the rule now and see which ones change. Okay, 1 fell off out of the 5. All right, good, that's okay. So 1 I would have lost or would not have taken. That may have been profit or may have been a loss. It doesn't really matter. That's not what I care about. Now I apply rule number 2. Oh, shit. Now I actually lose more than I win. Fine, but it could be that rule number 2 enables rule number 3, which now flips all those losers into winners and the one winner into a loser. Yes, it is being recorded for those wondering. Now, what was I? So this is your back testing, and you're going to test once you have everything set up. There are certain sites where you can take a chart and remove to a certain date the charts that are coming, and then do your analysis and you apply your trade, and then make that, you go through your flow chart and you go, okay, so this trade I would open, and then you press play and it will start loading the bars. Because the problem what most of you do is when you take a static chart and you do the back testing, you lie to yourself. And we all have that tendency, because in the left eye, you're seeing like, okay, based on this, I should do this. And then you look on the right side and you go like, yeah, but I know the market's going to do that. So I'm just going to say to myself, I would have done that. Yeah, but look, you can lie to yourself as much as you want. your account in the current market that doesn't have those candles or or line or whatever chart you're using, but most use candles, right? Whatever you're using, right? Those candles aren't there, so you can't cheat that way. So when you're back testing, bloody don't do it, because you're just lying to yourself. And then you go like, I have a great strategy. I have a strategy that if I do this, I consistently get a win rate of a little bit over 50% or 60% win rate in certain market conditions. In bearish markets, it does this. In bullish markets, it does that. And in these currencies, it does this. Amazing. And then you start trading with it, and it literally backfires every single time. Oh shit! Why? Yeah, because you kept lying to yourself when you were back testing the damn thing. And you weren't willing to just put in the work like, okay, where do I need to adjust my rules and my point of view on how to approach this to fix that and flip it around? I've literally had people that had a consistent win rate of 20%. So I told them for 1 week, do everything opposite. When you click a buy, you click a sell instead. Just flip the buttons in your head. Hey, I'm profitable now. Yeah, because you are fundamentally approaching the market the same way over and over and over, expecting a different result. Yeah, the funny thing about the market is it's not really that complicated. It doesn't shift that much. No matter what the market type is, there's two types of market, right? Bull and bear. They have certain characteristics in how the markets move. And within that, there's not a whole lot of fluctuation because it's still humans doing the motions. So it has a similar flux, more, less in range, less volatile, more volatile, depending on the year, depending on the market situation, geopolitical situations. But in essence, how it moves is pretty much the same. It's always been the same, right? Up, down, up, down, up, down, up, down, up, down, in a slight slant up, in a slight slant down, or sideways. That's the only three ways a market can move. It doesn't circle backwards, right? It doesn't make a parabole like an actual one, like straight up and straight down, right? In the long run, there's a direction. And this is what the bigger parties do, right? Big investment funds and stuff hedges, okay, we expect the euro to grow 6% this year, like it's consistently been doing for the last 5 years. So what do they on January 1st? Buy. And let it run for the year. But they don't buy like we do. Right? It's a completely different thing. Let me just answer. So now we've done our back testing. That all works out. Everything is fine. We're all happy. Happy donkey dory. Now, that is how you set up your trading strategy. You're now going to simply just implement it. And with that, for those that get the recording, I want to thank you all for listening. Those that want to pop out before the Q&A, thank you, and we're going to go to the